You think we're kind of nearing the end of this tightening cycle and maybe, fingers crossed, being able to put our Fed to bed for like 6 to 9 months, maybe longer?
Nice to see you, Brian. Look, yes, the Fed is nearing the end of its tightening cycle. But although it's moving slow and it's getting closer, this isn't really good news. Because what we've heard from Powell yesterday is that they have slowed down the pace of tightening because they're getting close to the peak. But that peak is going to be above 5%, so that's higher than what the market was originally expecting going into yesterday's meeting. And not only that, but they're not going to be cutting rates next year. They were very, very clear in that discussion point that there will be no loosening of monetary policy throughout 2023. And unfortunately, when you consider that you've already seen 425 basis points of tightening in just less than 1 year, there is going to be a fairly significant economic impact still on the way, which unfortunately the US economy is going to have to deal with.
We've been so almost singularly focused, Seema, on the Fed for the better part of a year. Once they are, let's all hope, because I'm just tired of talking about the Fed, once they are out of the picture, or at least out-ish of the picture, what then? Because the markets have to focus on something. Is it China? Is it Europe? Is it energy? What is it?
So there's going to be a couple of things which are really important themes for 2023. One, still on the negative side, unfortunately, is still going to be earnings. So as I said, there's going to be an economic impact from this very significant tightening of monetary policy. So we are expecting earnings to slow down through 2023, and unfortunately, that is not good news for equity markets. Now, on the positive side, there will be opportunities globally. So if you think about, as you mentioned, China's reopening should have a fairly important impact on not just China's economy, but actually all of their key trading partners, of which there are many. So if you think about the rest of Asia, you think about parts of Europe, they will benefit from China's reopening. So there could be opportunities outside there as well. So there are some good stories, and hopefully, as you said, the US monetary policy one is something that we won't necessarily still be talking about at this time next year.
Do you think it's real, though? I mean, China's making all these moves, but pardon me, I feel like we've been here before, and then they just lock things back down. This time kind of feels a little different, Seema. Do you think it's real? And what would be the global market implications of kind of a, quote, full China reopen?
Look, I think it's right to have a few concerns because inevitably this is going to be a little bit messy and chaotic. As we've seen in so many other countries as well, is that once you reopen the economy, infection rates do soar, which is exactly what we're seeing in China in the last couple of weeks. But given that policy officials have been very, very clear about the intention to reopen, it's unlikely that they will go back on it. And you are seeing a slight change in their narrative. One example would be starting to compare COVID to the normal winter flu. So there are these kind of changes in narrative which suggest that they really are quite intent on reopening. So when we get to that point, which I have to say, won't be imminent, it takes a bit of time, probably as you get into warmer weather is when they feel more comfortable. At that point, we should see a positive economic impact for China. And parts of Asia, especially something like Hong Kong, Singapore, Malaysia, Indonesia, they are going to be key beneficiaries. In addition to that, Germany is another key trading partner for China. So we would expect there to be a positive growth impact for Europe as well, just from China's reopening.